Nitin Bhuta sir to Nasik branch for
Thank you.
this webinar. It's my privilege to introduce our today's speaker, such a learned and versatile speaker, Nitin Bhuta sir, who is become graduate CWA FCA. He has graduated from Mulund College of Commerce, Mulund. He has completed Chartered Accountant just 16 days before completion of his articleship in the year 1992. He is a proprietor of Nitin Bhuta and Company Chartered Accountant, Mumbai-based firm. Sir has secured 13th rank at all India level at intermediate level of ICA examination. Sir is regularly speaking at WRC, matching GST certificate courses, as well as at various study circles in Mumbai and as well as outside Mumbai. He was one of the panelists of WRC for resolving queries on GSTR 9 and 9C. Sir has contributed to pen articles in publication published by ICI on appeals before CIT appeals part 1 and FAQs on appeals before CIT appeals part 2. Besides that, he is regularly publishing his articles on Tax Guru and other elite professional journals like GSTPM Journal and so on. During his training as well as after he established his practice in 1992, he had the privilege of getting exposure to various industries like advertising, entertainment industry, research company, pharmaceuticals company, manufacturing industry, banking, celebrity management companies, medical fraternity, wellness industry, content development industry, and the list goes on. In the field of accounting and direct taxation as well as management advisory services. Presently, he is actively involved with limited scale of doing audits, direct and indirect taxation, management and advisory, as well as handling of litigation matters, etc., of corporate as well as non-corporate persons. Presently, he is actively involved waiting out to the drafted legal documents pertaining to business arrangement from the tax compliance perspective. Apart from that, Sir is fond of traveling. He loves traveling and reading. He has traveled almost all the parts of India. He has also visited USA, Thailand, UAE, Malaysia, Singapore, as well as Caribbean islands. So with this short introduction, I request our today's speaker, CA Nitin Bhuta sir, to address the members of Nasik branch.
Thank you, Sohil, for kind words of introduction. Today, the session is on the direct tax. In fact, my second session as a speaker was commenced from Nasik branch only, and I had spoken on the indirect tax on 23rd May 2018. I'm blessed to get an opportunity to speak on both direct as indirect tax on a regular front. So with this, I will start my presentation, and I'm immensely thankful to the branch to give me this opportunity. And I hope members who are attending this particular session will enjoy the journey of learning the disallowances as well as the TDS reporting, which is the core heart of today's session. I hope I'm very perfectly audible as well as this presentation is visible.
Yes, sir. Yes, sir. Perfectly.
And this presentation will be shared with all the members who are attending this particular session. That is what I have told to the organizers. So
yes, sir. Yes, sir. We will
need not worry about the availability of the presentation. So typically, all the speakers will put their disclaimer at the end, but I would like to put the disclaimer in the beginning itself. I will say whatever I'm going to say, that is as per my understanding, and it is not binding on ICI as well as the branch where I'm delivering this particular session. I urge each members to go through the law provisions on their own and advise their clients suitably. As each situation can be peculiar, considering the facts and the matters involved. And if during the presentation, if I give any examples and they are resembling to your clients, please note, I have no intention to disclose anybody's affairs in public domain in any of my presentation, and that is purely coincidental. So that fact should be kept in mind. It is said by Benjamin Franklin, in this world, nothing can be said to certain except death and taxes. And there is another British proverb which says that many people are penny wise but pound wise foolish. What is the relevance of these two things in this particular presentation? Here, when we are doing the disallowances of expenses, it results into payment of taxes by the taxpayer because of the various conditions and the stipulations that are provided under each of the sections, and each of the clauses mandates the reporting of such requirements. And that responsibility is casted upon the auditor who is uploading such a report, and taxpayer is reluctantly or with the open hands, they have to accept that these are disallowable. Similar logic goes with the TDS reporting also, which will be touching upon as required. Now let us read and explore the path of disallowances and TDS reporting. Basically, when we look at the tax audits, they are applicable to income which is subject to tax under the profit and gains of business or profession. All of us are aware our forms are Form 3CA, 3CB, and 3CD. 3CA is typically for the corporates, and 3CB is typically for the non-corporates. And 3CD is a subset of either Form 3CA or 3CB as applicable. But the main report or a main certificate is either 3CA or 3CB. And that is to be issued based on various conditions, parameters provided under the each respective sections under which such a tax audit is carried out. But now the filing of the tax audit report is mapped with artificial intelligence, automated examinations, tools, risk management strategies, machine learnings, and whatever the reports that we upload on the portal and which are approved by the clients and which are also considered for the purpose of the verification of the income tax returns that we file. It plays a very significant role to decide what it can mean. So basically, whenever we are drawing up our financial statements, they have to be compliant from the taxation aspects. They need to be compliant from the audit aspects, as well as reporting, certification. They should be aligned to accounting standards. And if ICDS is applicable, that is income computational and disclosure standards, then it should be aligned to that only. And based on that, assessment of a taxpayer is carried out. Tax care can be whatever the people defined as per Section 2 as a person, And with that, here, the objective of this particular session is to concentrate only on the disallowances and their impacts while filing the tax audit report. So I'm not going to get into the details of other angles. ICDS, I think there is a separate session. There is a separate session on the AMT and the MAT reporting also. So I'm not touching upon that angle. And the TDS reports. So here, when we look about the disallowances, which are specifically provided under the deductions of section 30 to 36, there are express disallowances provided under section 40. And there can be many other situations where disallowances can be made suo motu by the taxpayer if he feels that to be appropriate, and the residual situations. Similarly, for TDS reporting, deductions, transaction reporting, suo motu compliances, interest, and other compliances are expected to be reported by the taxpayer if taxpayer has not complied with the same. But here the moot question that comes to my mind, if the certain expenses or certain items of revenue account, which is either a profit and loss account or an income and expenditure account, has to be disallowed, do we need the mandate of a law to disallow the same? Can't it be disallowed suo motu on our own by the taxpayer? Especially now when we are considering the limit of tax audit has been revised to 10 crores, subject to certain stipulations and conditions. I'm sure in the yesterday's session, Chitrale sir must have discussed all this angle in detail. So let's jump into the next. But before we jump into the disallowances clauses, I would like to create certain foundation for the discussion. And I would like to emphasize the discussion linked to a technology, which is very, very important to understand what it can mean if we miss on disallowing the expenses. All of us know the income tax law is a 100-year-old law. But when we look at the last 2 decades timeline, virtually, which started from 81, compulsory filing of the returns was introduced from 2006 in respect of the corporate returns and the TDS, followed by establishment of a CPC in 2009, and 2014 was a trigger point where today what we are witnessing, everything in the form of a faceless foundation was laid by the Finance Act in that particular year. And after that, host of changes have been introduced in the way assessment is carried out by the tax department. And we have observed the setting of the new portal in the month of June 2021. But one objective of a tax audit, which is expected of, is to reduce the burden of a assessing officer, because he will rely on the information that we are reporting for the purpose of his review, his ascertainment, his determination. And if we make any particular kind of mistakes, in that case, it may result into the scrutiny proceedings or it may result into the reopening of the assessments. So my fundamental request to every participant who is attending this thing, they have to walk an extra mile to file absolutely accurate tax audit reports to the best of their ability and understanding, so that client also don't suffer and we as also professionals don't suffer. And if it is accurately filed, it creates the positive atmosphere for each one of us. When we look at the tax ecosystems of any country, anywhere in the world, typically I'm just giving the example of income tax law, but every law, basic structure remains the same. It doesn't change. Every law will have its acts, rules, forms. Under income tax, when we talk about it, is a specific heads of income. And for each of the heads of income, directions are given which income would be accessible to tax. And what are the discretions provided, what are the restrictions provided, followed by the prohibitions. And all these three things are considered in framing the documents to be filed, which is typically the ITRs and the tax audit forms. What procedures to be followed, what are the alternative options available, considering what would be allowed, what would be deductible, and what will not be allowed to be considered as a deduction against that particular heads of income, and the time limits. And if we don't comply with the requirements, it results into penalties, demand, recovery, prosecutions, interest, late fees, whatever we call it as. This is the broad structure of any tax ecosystem. You can imagine, you can try with any other business law also applicable to the enterprise, but ultimately all will boil down to this particular angle. So typically, we are going to concentrate on this parts, transactions, because when we are signing the audit report, we are examining the transactions carried out by the business unit, which is subject to tax audit. And transactions are forming part of the books of accounts, which also we are reporting as certifying in this books of accounts I have examined. We are also certifying the financial statements, and now it is with the UD, which was not the case in the earlier years. Typically, the auditor also helps client to prepare the computation, self-assessment tax if payable, based on the 26 AIS, TIS as applicable. And he also helps to file the ITR and TAR. So I think the whole assignment is part and parcel as a package scheme of incentives for the clients. And based on the ITR and the TAR filed, we receive the intimation, which is typically everybody is known as a 143(1)A, which is nothing but a arithmetical accuracy of the information that we have filed, nothing beyond than that. Few cases are selected for scrutiny. Assessment is carried out in the faceless manner, or if it is a high value cases where search seizure is involved, then it gets assessed into the central circle. If there is a foreign assets, then it goes to the international taxation, depending on the nature of this. And based on this assessment, if there is a mistake, we can go for a rectifications. And same thing, rectification can be applicable to 143(1)A also, if it is a prima facie mistake, whereby whatever the return of income that we have filed, it is either accepted or it is increased or decreased. Exemptions allowed, not allowed, deductions allowed, not allowed, and refund either processed or refunded or it is rejected. So if we look at all this, I have used the abbreviations, and if we are not happy, we go with the appeals. That is the first stage of litigation. And if we are not also happy with the verdict of appeal, we go to tribunal, High Court and Supreme Court, or a REIT based on the facts. So typically, we will be involved in the determination and the ascertainment of the accurate information that we would like to report. Same way, when the government official do the assessment, they also do the determination and the ascertainment. But we are concerned with the above part. We will be concentrating on only that angle. So typically, when we look at the drawing of the financial statements, it is based on the nature of an assessee, based on his business activities. It determines how the financial statements have to be prepared, what method of accounting one is following, whether cash or mercantile. If it is a cash system of accounting, ICDS is not applicable, but if it is a mercantile system of accounting, ICDS would be applicable. AIS and TIS, SFT transactions reported, 26 AS. And we, based on our understanding, we will give the tax treatment to the accounting transactions. Based on that, we will draw up the financial statements, giving the benefits of tax benefits, deductions or exemptions, documentation and reporting, TDS, TCS, advance tax, self-assessment tax, GST, working compliance, all will do. Audit report will be prepared considering the related party transaction under lenses. And whatever we report in the financial statements, it should match with what we report in the computation as well as the ITR. But at times we have observed that there can be deviation in reporting for the reasons known or unknown, but why it happened. But this year, when we are doing the reconciliation and the audit, essentially, we need to reconcile the data with AIS and TIS. And please note, ICDS is only for the computation purpose. It is not forming part of your financial statements at all. It's an adjustment to your determination of a total income. So that angle, keep it in mind. And if any accounting standards are applicable, please, they have to be followed. And if you are not following, then it is to be reported as an observation and remarks suitably. And it may mean to give a qualified audit report in the form of a tax audits. And do reconcile your 26 AS, AIS and TIS before filing the tax audit report. It's just a sincere suggestion. ICDS, next session, the respective speaker will take up. And when we are doing the audit, we need to have all kind of a dashboard data on our dashboard to decide what we are signing on a dotted line within the time limits as provided, whether it is accurate, satisfactory, and we don't have any doubt what we are signing, especially that is to be kept in. And you may use any combinations to reach any conclusions, especially if you come across any particular typical case or some typical situations, always prepare your notes and keep in your working file as a suggestion. This is the tax charter, which is a normal slide I use in all my presentations, which all will be available. Now let's look at something before we go into the subject. It's a food for thought. Typically, when we visit the couple of electronic stores or a couple of small shops, and we would like to shop something, the person who's sitting on the counter tells me, sir, this stock is not available. Or an electronic department store tells me, sir, this is not available. Same thing goes with the computer vendor, or it may be anything else. Okay, this product is not available. If he is able to report such a information in the GST records by GST R1 details of quantitative, he is able to generate the e-way bills. But when we look at the financial statements prepared, especially with reference to the inventory records, Many people make a remark कि inventory records not maintained or inventory is valued, verified, certified by the proprietors, partners, HUF, or whoever the responsible person is. Can we say that if you are disclosing the quantitative details in another applicable law, can you say that while issuing the tax audit reports? I'm just parking the issue for the which everybody can think and take a decision. Why do we recommend this? Is it because we would like to do the aggressive tax planning? In my humble understanding, one should not do that. And presumptive system of taxation, especially. Many people I have seen taking the advantage of claiming the basic percentage limits given, where their assets are much more than what they are offering to tax. Can they still follow? My answer is no. According to me, whatever is the exact percentage of profits, you should declare. I can be subject to corrections, but my view is this. It's my considered view. Though I don't prefer presumptive scheme of taxation at all. If presumptive scheme of earning is included in the profit and loss account, then that should be reduced in the computation of total income, and that should be specifically reported in the audit report as applicable, if it forms part. Let's take some of the examples of the tax audit limits. I think this has been deliberated yesterday, but still I'm discussing some conceptual concepts. If a milk trader is having a turnover of 1.5 crore, all in cash, can he opt for 44AD? In my humble opinion, he can, but he has to pay 8% tax. But when I look at practically, his margin is only 1 rupee per liter. So in all probability, he will go for ITR 3. And if he goes for ITR 3, then he has to do the compliances as applicable. ITR 3 and ITR 4 is for business income returns. Let us assume that he opts for 44AD and he declares 8% profit. And he has made payment of more than 10,000 cash to several people. In that case, will they be considered as disallowable under section 40A3, which is one of the clause of tax audit report? If we look at the provisions of section 44AD very closely, this amount will be disallowable, even if you have declared 8% profit. And same logic gets extended to section 43B also. So keep that in mind. Let's take the another example of a restaurant who is having a turnover of 5 crores, 90% in cash. Whether the tax audit will apply? Tax audit will definitely apply. But let us change the structure. Restaurant is receiving 96% from the Swiggy and their cash receipts are only 4%. In that case, whether tax audit will apply, even though turnover is 5 crore? Answer is no. Because Swiggy will make a payment through electronic means of communication to the restaurant, which will be routed in their banking account. Even though Swiggy will collect the cash, it is they are collecting on their account. They are not collecting on this. It's a basic legal angle to be examined. So that will apply. So keep that factor in mind. Another example, builder is receiving rupees 15 crore as an advance towards under construction projects. Will TAR apply? Answer is yes, it will apply, because look at the judgment given by the Lucknow Tribunal in the case of Gopal Krishna, where section 44AB says sales, turnover and receipts. So gross receipts will form part of this, and based on that, audit would be applicable. We have also observed that many of us disallow the expenses in the tax audit reports, but we don't consider that in the computation as well as the ITR filing. Because of that, a lot of people have received the mismatch notices. Why, if we have disallowed in the tax audit report, we should mandatorily disallow in the computation as well as the ITR, because consequences can be severe if the penalty notices are invoked under section 270A, which we will see in the subsequent slides, but that has to be taken into consideration. Please do reconcile. If you are providing all the services, ensure that there is no prima facie error in your reporting. If you look at the registration details reporting requirements of the tax audit, it says that every law that is applicable to the enterprise, such details should be reported as per the guidance note issued by the ICI. Do we need to report every law that is mandatorily required to be reported? And if that is not registered, do we need to quantify and report such a values of the disallowances? Disallowances will happen only if it is debited to the profit and loss account. But if they have not complied, if they have not registered, then that disallowances will not come. Probably you can just make a report such information in your observation and remarks. Take care of that angle. All of us are aware what are the limits of audits. Let us take an example of a doctor is carrying on a profession and he is selling medicines also. Can he opt for section 44AD for sale of medicines? The answer is no. The reason is professionals are not allowed to opt for 44AD. So they cannot opt, but they can select 44ADA in respect of their professional income and offer. But though I don't recommend AD presumptive scheme, I don't recommend at all. Other very common example, which is expressly provided under the Act, the firm opting for the presumptive system of taxation can firm claim the deduction on account of the remuneration and the interest paid to the partners. It is expressly provided under the law. That deduction is not permissible. So if you are filing any compliances or if you are doing the audit reports also in conjunction with presumptive sections, please take care of that angle very specifically, even though remuneration and interest payable to the partners is provided in the partnership deed. Another question that comes to mind, can a company opt for presumptive scheme under section 44AE of the Income Tax Act? Answer is yes. 44AE says any person, which includes company also by definition. So in that case, take the second corollary. Can a non-resident assessee opt for a presumptive scheme of taxation under section 44AE? Answer is yes. Any person includes the non-resident also. You have to opt for ITR 3 and file suitably. But non-resident cannot file ITR 4 at all. Another question that comes to mind, which is relevant for all the chartered accountants attending this particular session. If you receive the remuneration as a partner, can you claim the benefit of 44AD or 44ADA? My answer is no, though there are a contrary judgment to that effect. But why I say no? Because it is an appropriation of a profit from the firm to the partners. Secondly, if you want to treat under the presumptive scheme of taxation, would you like to take the exposure of getting registered for GST? Will you do the audit if applicable? it's a food for thought. According to me, one should not venture in. And this is remuneration and interest earned by the partners. It's not subject to levy of GST as per my understanding, because it is not a supply as defined under the GST provisions. Only thing which you can claim as a deductible is a provision paid by the individual partners, and if there is a money borrowed for investing in that particular firm or a LLP, as the case may be, and any other expenditure which is relevant to earn that income, provided it can be justified. Otherwise, unjustified expenses will be subject to disallowance. So when we make any kind of a mistakes, either of not disallowing or disallowing and not reporting while filing the ITR, it can be unintentional mistakes or it can be intentional mistakes. If it is an unintentional mistake, one may get the option of considering that as an under-reporting of income, which is typically I call as URI. URI, please don't recall the movie name, Yuri the Attack. But URI here, it means under-reporting of income. When it is an intentional, it is a misreporting. It is MRI, it is considered as a severe. And please note, misreporting is a subset of under-reporting. And due to such a mistakes, it can be a defective returns, rectification. It may result into demands, penalties, prosecutions, and whatnot. So that angle has to be taken care when you are doing the compliance. Typically, when we look at the penalty provisions which were old, it provided for a discretionary penalty of 100% and 300% on account of the concealment of particulars of income or furnishing of inaccurate particulars of income. Now, concealment of particulars of income is replaced by the under-reporting of income, whereas furnishing of inaccurate particulars of income has been replaced by the misreporting of income. And now the penalty is 50% if it is under-reporting of income and 200% if it is a misreporting of income. Department invariably will invoke the misreporting of income. This is what the thing is. Still, according to me, penalty is today also is discretionary, it's not mandatory, though the wordings, many people take a view that it is mandatory. According to me, it is not. And this is when we look at the definition of the terms of under-reporting of income or misreporting of income, they are not defined under the Act. So one has to rely on the normal understanding. They have given the illustrative situations under the respective section 270A, what can be under-reporting and what can be misreporting. And based on that, we need to evaluate. They are all inclusive definitions. So there can be many more situations than what they have reported or they have specified. But only grace is the order has to be speaking order. And if there is a defect in the order, you can seek for the alternative remedy by appeals and things like that. And it can be considered as a void and it can be deleted also. But here, one thing one should take care. Whatever is required to be disallowed in the tax audit reports, as per the provisions of the Act, which are specifically mentioned, please disallow, don't take a chances. This is a sincere suggestion to all. This is not relevant for the topic, but I said it is correlated. That's why I'm just making a reference of this particular discussion in this particular session. And when I say it is discretionary, the reason is the words used are penalty may be levied. An issue of show cause notice itself provides the penalty may not be leviable. This is my experience with the faceless assessment, where we have received the draft assessment order and we have filed tons of documents and we have got the relief by hope of positive order without any additions. So I still am a considered view. It is still discretionary, not mandatory. Anyway, one can take the defense based on each facts. So now let's come to the disallowances. Especially we will start with the deduction sections, which are section 30 to 36. But we'll cover each basket wise, which are of the similar nature, so that the understanding becomes very easier. What I have done, for each sections, I've summarized the information, and wherever I could lay my hands to a supportive judgments, which can be relevant for each clauses of the tax audit report, I have summarized for the benefits of all of you. So typically, when we look at it is only in respect of the profit and gains of business or profession, where rent is paid, rates are paid, taxes are paid, rates and taxes relevant to buildings, and repairs of the building and insurance for the building, which are occupied for the purpose of business or profession. If you have not occupied the premises for the purpose of business and profession, then that expenses will not be eligible to be claimed as deductible. So if you come across such a situation, then you should expressly disallow such expenses claimed by the taxpayer in their financial statements. Now, in respect of section 30, it is allowed to owner, lessor, tenant and lessee both on account of the current repairs, land revenue, local rates or municipal taxes. And even if the premium is paid in respect of the building, then also it is deductible. But mind you one thing, if nature of expenditure incurred is in the nature of a capital expenditure, then it is expressly disallowed. And you got to report specifically in your computation as well as in your tax audit report. Similarly, personal, not allowed. And if the taxpayer is treating that as an income from house property, then also don't allow any benefit of the deductions to be in the tax audit report. And if he does not agree, please qualify the report suitably. You can write as many notes, as many things that are required to safeguard your thing. So that is the one angle which is to be taken. Now let's look at and this is in clause 21A. This is required to be reported. There is one interesting example. If I have paid upfront interest payouts in respect of the issue of debentures, can I claim the same in the year of payment? Yes, you can claim. That is given by the judgment of Taparia Tools, which is Supreme Court judgment, which can be used. But always check offer documents as filed for the issue of debentures. Examine the board minutes, examine everything, and then take a suitable call and decide accordingly what accounting treatment to be followed. And then one has to consider whether it is to be claimed as a deductible or not. Let's take another example. Huge repair expenditure is incurred by the taxpayer. Again, that is allowed. Absolutely, there is no doubt at all. In respect of the rented premises, it can be allowed in the year in which you have done the payment. There is no bar. But if the TDS are applicable, then that compliances you got to do. This is the judgment of IKEA Trading, Delhi High Court, Delhi Tribunal, sorry. But do check examine the bills, GST codes reported, and whether proper TDS compliance has been done or not. If TDS compliance is not done, then probably you need to consider the disallowance under section 40 suitably. Again, we come across many situations. The project is clients start many new projects, but sometimes they don't get fructified because of the feasibility reasons or not possible. Then can they be considered as revenue expenditure? The answer is yes. Because by incurring such an expenditure, no capital asset comes into the picture which can be capitalized and one can claim the depreciation. One can quote the judgment of Bombay High Court. And if you come across such a situation, in the observation and the remarks, you can quote this particular judgment, and that can be act as a support for you. But always examine the documentation. Documentation is a key now for almost every law that is applicable to any business enterprise. License fees payable to a software usage also are considered as allowable, deductible. There is absolutely no way. GE Capital, Delhi Tribunal. It is only right to use. It's not a capital expenditure at all. But if it is a period is provided, ensure key if you are following a mercantile system of accounting, do make a provision for prepaid suitably and claim the expenses accordingly. And this can be applicable under the respective section 30 as well as under the section 37(1). These are the common situations. Let's take up. I have repeated the section provisions in the presentation itself, which can be referred to by in the Act. But whatever we have discussed, it is covered in the previous slides. Now let's look at the next section 31, where it pertains to only repairs and insurance of machinery, plant and furniture. So if taxpayer wants to treat that as a revenue expenditure, then it is not permissible. So you got to report suitably. If it is a personal machinery, plant or furniture, even that cannot be claimed as an expenditure. And it is only thing which you need to differentiate between section 30 and 31. Section 30 is for both owner as well as the tenant, whereas section 31 is only for the owner. Nobody else can claim that benefit. If you look at the readings of the section, if you read the section simultaneously together, you will observe that more or less the drafting that is used in every section is more or less the similar. Current repairs, even a current repair was there in section 30. Premium paid in insurance against the risk and damage and discretion of. It is not the premises, it should be machinery or plant and machinery is a typo error. But one should take care of that angle. Let's come to the most common section which we encounter every year, depreciation. In depreciation, the asset has to be owned by the taxpayer. It should be used for the purpose of business or profession. And if it is not used for the business or profession, which means it is used for the personal use, then depreciation is not permissible. And depreciation can be claimed on the tangible assets, which can be in the form of a immovable or a movable assets, or it can be intangible assets, which are know-how, patents, copyrights, trademarks, licenses, franchises, or any other business or commercial rights. Please take care, don't claim the depreciation on a goodwill of a business from assessment year 21-22 if it is self-created. If it is acquired, we will see in the subsequent things. Owning is mandatory. If you don't legally own the asset, then you can't claim the depreciation. And this has been emphasized in many of the litigation matters, as we will see in the subsequent slides. And please understand that your classification has to fall into particular class of block of assets. And under the income tax, the depreciation only is on WDV method. There is no concept of the straight line method at all. It is only WDV. Please take care of that angle. Please be particular about the rates that you apply for claiming the depreciations. One more thing. If you have claimed the ITC in respect of any capital items, capital expenditure, as per the provisions of the GST Act, don't claim depreciation on such a ITC portion. If you have claimed expenditure as deductible under Section 35, then don't claim a depreciation on that also. Please take care of this angle. But here it provides that asset can be owned wholly or partly. Here the one issue arises. If it is owned or co-owned, what happens to ITC credits on such capital goods? Who will claim? Is it possible? Will a supplier issue the invoices in two names, mentioning the percentage? According to me, that is a very difficult thing and is not practically possible. Practically not possible. And if you are using the property as the business asset, you got to provide for a depreciation as per explanation 5 to section 32(1). Take care of that angle, which is now mandatory. Earlier, it was not, but now it is mandatory. Here, even if it is you own the asset, it is ready to use, then also depreciation is allowable. Citation of Delhi High Court is, I have quoted Radio Today, that will support the requirement. It is quite possible that sometimes asset is ready to use, but it is not commercially used. Then the depreciation is another very common thing. Due to expansion of business, authorized capital of the company is increased. It is to be considered as a disallowable, but if it is relevant for the plant and machinery, then you can capitalize as a part of the plant and machinery, claim the depreciation, and alternatively, you may claim it as an amortization of expenses as permissible. Citation, but please examine the accounting treatment suitably. Lessee cannot claim the depreciation under Section 32, as there is an absence of legal ownership. This is provided in case of the Mother Hospital Private Limited. So, legal ownership is the base. If your title deed is inaccurate, or if there is a defect and the title is not clear, remember you got to report such information in your ITR 6 also. In case of the corporate associates, about the movable property, whether owned, not owned, owned in the name of director or what. And now with the changes in the disclosure in the Companies Act 2013, all disclosures are transparent. Fortunately, all the management through you, whoever the advisors are, they have to disclose such facts. Earlier, they were not disclosing. This is again just a repetition. If you observe in respect to the computer system, many aspects and the many components are integrated, then you can claim the depreciation at the rate of 40%. Earlier, this citation was 60% when the 60% rate was applicable, but even it holds the fort even today also. Similarly, if there are routers and switches which are integral part of the computer systems, subject to the technical verifications, still you can claim the depreciation of 40%. IBAN. It's a Mumbai tribunal judgment. You can use as a reference in your observation and remarks, because there is no option available to write in the depreciation schedule, unfortunately. Another very common mistake which is observed in the additional depreciation claimed by the taxpayer, but if it does not involve production or manufacture of an article or thing, it will not be considered as eligible for additional depreciation. Intangible assets. This is the new breed workforce valuation, customer list, and other business rights. Self-created, no depreciation. Acquired, you can claim the depreciation. Joint ownership, possible. You got to check the IPR laws, documentation, and report it appropriately. But again, in case of the joint ownership, if it is subject to levy of GST, how will you claim? How will you document? That is also a key. This is the just reproduction of the section 32(1), which I am not touching upon. Let's come to the other deductions. Insurance. If it is necessary for the purpose of the raw material, stocks, inventories, works in progress, stores, all is permissible. But in respect of the insurance companies, if they are paid for their employees, and if it is mandated by the law, then it is deductible. There is no bar. Again, very common instance of financing the business. Borrowed money. If it is only borrowed for the purpose of business or profession, it is deductible. But if it is a personal borrowing and for the personal use, then interest on monies borrowed cannot be claimed, even if the compliance of TDS has been done by the taxpayer. And this can be claimed irrespective of the fact whether it is capitalized or not. It is immaterial. But one should always take a care. Interest on monies borrowed for financing the capital expenditure before they are put to use cannot be claimed. After they are put to use, it can be claimed. That angle, put to use, is one of the conditions of section 32 also. Keep that angle into the mind. And this is the last clause, explanation, which is provided. Recurring subscription paid periodically by the shareholders or subscriber to mutual benefit societies, which fulfill the conditions as may be prescribed, shall be deemed to be capital borrowed within the meaning of this clause. So even a borrowing compliances has to be taken into consideration if you are doing the audits of the societies suitably. Let's come to a very general deduction clause, which is everybody has encountered in our profession, which we know the expenditure should not fall in the sections 30 to 36. It is not in the nature of a capital expenditure or a personal expenses, and such expenditure is laid out or expended wholly or exclusively for the purpose of business or profession, then it shall be allowed in computing the income chargeable under heads profit and gains of business or profession. And the explanations are provided, which we must have justified every now and then in our scrutiny assessments or whenever the inquiry has come. But here one thing which comes, CSR expenses which are mandated by the law, they can be considered as relevant for the purpose of section 37 also. But here one instance which comes to my mind, many people incur the expenses for self-education before they start up the business. In that case, that will not be considered as a allowable under section 37(1). It will be disallowed. But after the business is set up, and if it is all conditions are satisfied, then probably that can be deductible under section 37(1). But there is one explanation which is added from the assessment year 22-23, which has got a very significant implications. And it is applicable to every business enterprise. It can be to our own return, it can be to our any kinds of audit returns, whether it is manufacturing, trading, professionals, or every kind of assessee. Any expenditure incurred by the assessee for any purpose which is notified to be an offense or prohibited under any law, the emphasis is on under any law, means any law known to us and unknown to us, then that will be treated as disallowable if it is in violation. So this angle, for example, I'll give you a very simple example. All our clients would be having a car, they break the signals, and that penalty is paid. That would be disallowed under section 37(1). If one is into the food industry, they do a violation of a food mixing, and if they pay a penalty, that will be disallowed. It can be a medical, FDA. There can be many reasons. So when we are doing the audit, especially very, very significantly, please examine the legal and professional charges under lenses. And if any rates and taxes are debited, that also you examine very, very closely. And with this explanation added from assessment year 22-23, earlier it was restricted only for India. Now it is extended to anywhere in the world. Imagine suppose if your client has done the violation of a IPR law in UK, and for which he has paid the monies, that will be disallowed, specifically under this particular section 37(1). And you are expected to report such a disallowance while issuing the tax audit reports. This we have already covered. It is also similar to 37(1), but let's come to the section 40, which is another biggest challenging aspect for most of the auditors to report. 40A1 is typically the international transaction, and which governs the provisions, which are governed by the provisions of section 195. And if you make any payment outside India, when you do any make payment outside India, typically you are issuing form 15CA, 15CB as applicable, or 15CA, 15CB, whatever the forms that are applicable, where it is you are attesting, considering the provisions of the double taxation avoidance treaty, whether TDS is applicable or not applicable. But if you make a mistake of not deducting the TDS on the international transactions, then the whole of such expenditure is disallowable. And you are expected to report such a details in the clause of tax audit. And the moment you report such a information in your tax audit report, this matter travels to the international taxation department of the country. Similarly, for the domestic transactions, only 30% of such expenditure is disallowed. But only blessing of this particular section is, if you pay the taxes in the either of the sections on or before the time limit specified under section 139(1), then such expenditure is allowable. But in that case, you got to file the TDS returns, pay the interest. If late fees are applicable, then that is to be paid. But here one challenge that comes, tax audit report has to be uploaded by 30th September. Till that time, if this TDS is not paid, as an auditor, you will disallow. And taxpayer can claim in their IT returns, while filing the ITR returns, we have paid the TDS, and thus the deduction is allowable under section 43B. So that angle has to be taken into consideration. And for such a limited purpose, tax audit can be revised for just the allowing the 43B allowances. That's it. Otherwise, personally, I will prefer don't allow such a reporting to occur at all, if it is possible. It is a sincere suggestion to all. Take care of that angle. Then at times we always have a question, will section 206 AA will override the DTAA? Answer is no. DTAA will have the overriding impact, and it is followed. The judgments of Pune Tribunal are shared here, and you can always, if you want to safeguard something due to discerning view, you can always report in the observation and remarks. Again, if TDS provision compliances are done by the agent on account of the reimbursement of expenses, then also disallowance will not trigger under section 40A. There's a tribunal judgment of Guwahati High Court on this, which may be kept on our working papers. Another very common example, sometimes the payee is unidentified, or there is a unascertained amount payable to the vendors because of some reason or specific reasons. In that case, there is no requirement to deduct the TDS at source, even though there is a provision for expenses made. There is a judgment of Dishnet Wireless. But do remember, when we make a provision of this sort, please report that in the contingent liabilities and considered as disallowable under clause 21G. Take care of that angle. Here, one more food for thought for everybody. If you are filing the balance sheets of the corporates and their contingent are shown, don't mix up these two things. That contingent liabilities are the external notes to the financial statements. And this is what you have debited to the profit and loss account. That's why you got to report that as a disallowable. Please don't mix two things. Many people have reported such a contingent liabilities in the tax audit reports because it is done by the junior, and junior doesn't understand the difference between two. And then it results into the all litigation coming up. Revision options not available. Time limits to file the belated or revised return is truncated now to 31st December. Please take care of this angle when you are reviewing the financial statements as a principle. Incorrect withholding of TDS also will not give you a respite. So please take care of that angle. You are deducting under the correct section. And if you deduct under the incorrect section, disallowance will trigger. If book entries are recorded in the books of accounts and reversed subsequently under section 195, then also 195 TDS will not trigger. It's a Erickson communication judgment of the Delhi High Court, which is very, very safeguard and which again validates section 195 TDS would trigger only when the payments are made. Please keep in that mind. If your taxpayer has paid the taxes overseas, then that cannot be claimed as deductible against the income. Tata Consultancy judgment. But if such taxes are eligible for set off against the tax payable by filing Form 67 before the time limits provided under Section 139(1), then you can file Form 67, report such information in the ITR, and claim the tax benefits by reporting the relevant information in the ITR as applicable for the period under consideration. No disallowance due to short deduction of TDS. Generic tribunal judgment, it's very useful for most of us if it is applicable. If on account of some transactions VAT is applicable, then such transaction cannot be subject to TDS. Though there are few commodities still are under VAT, but if that is the case, TDS will not trigger. Gillette India judgment is a very old judgment, but ratios can be still applied even today. If you are paying reimbursement of any expenses which is not an income of a recipient, then no TDS deduction needed, but you need to validate with the corroborative evidence to prove that it is not an income of a recipient. Then only this can be explored and this can be used for the benefit. Serener Healthcare Solutions, Bangalore Tribunal. Again, very common situation, commission paid to overseas agent who are providing services outside India. There also TDS is not required. Even after the addition of the explanation to Section 195, still the TDS is not required. Cesar Surze, Tribunal Panaji, still holds the fort. If your client is into listing, and for which he pays the listing fees, stock exchange fees to BSE, then also it is not subject to TDS. Kotak Securities Supreme Court judgment will help you. Composite consideration payouts, especially the installation, then they cannot be, if it is like you are installing the tower and you are paying the installation services, then that cannot be termed as a fees for technical services and it cannot be subject to TDS. Gujarat Pipavav Port judgment of 2016. And for which you can draw support from the definition of a composite supply under GST. But you got to examine the documentation very, very clearly. The vendor has to be the same. There cannot be a different vendors. Please take care of these angles. These are the all section provisions. Applicable for each of the things. Again, very common. Remuneration to the partners. It is under clause 40B. It is, if it is paid to a working partner, then only it is allowable. If it is paid to non-working partners, it is not deductible. You need to examine the partnership deed and take a call suitably. And if they are not authorized by the partnership deed, then also it is not deductible. Similarly, interest on capital cannot be more than 12%, which is a simple interest. Take care of that part. There is a limit of remuneration payable to the partners, and only that much is deductible. And that should be properly reported in the tax audit reports. Only working partner, non-working partner, no deduction. It is straight away disallowable. Book profit has been defined suitably, and based on that, computation has to be done. First, if the interest is provided 18%, then you will add 18%, allow deduction at 12%, and then the remaining, you will apply the remuneration limit and do the calculation accordingly. Similarly, whatever the provisions that are applicable to the partners, same thing they apply to AOPs or body of individuals also. Logic is the same, there is no difference. Now, certain circumstances which are provided for, which are under section 40A, where they are not deductible. Very important, related party transaction. When we look at the related party transactions, typically when we look at from a corporate angle, it is AS 15. All reporting has to be done according to the accounting standard 15. Or if it is a other than corporate entity, then it is the definition of related party transaction will come as per section 40A to B. The emphasis of this particular clause is key. Whatever we pay to the related parties, such amounts which are relevant for the purpose of running the business, they are reasonable, justifiable, they are not excessive. If they are excessive, then that should be disallowed under section 48 to be. You will report with the name, address of the person, PAN number, nature of expenditure and amount in the tax audit schedule, and you will report suitably. And if you think it is justifiable, please document the justification for the purpose of the records. Why? Based on which sometimes director would like to draw 1 crore rupees, but considering his previous history, if it is eligible for only 40 lakh rupees, he may drop 1 crore, there is no bar. But why? That is to be documented. Very, very important. You will do the TDS compliance, you will do everything. And let us examine one stage further. If you pay excessive amounts and GAR provisions are applicable, then the repercussions can be very worst. GAR provision reporting is compulsory from this tax audit report. So please examine that angle very, very meticulously when you're examining the related party transactions also. Always finalize the details well in advance. Treat it suitably. Never have the divergent values at the time of computation as well as after filing the returns. Have it same. It has to be finalized simultaneously. The best thing what we have practiced in our career, we finalize everything simultaneously. That really helps to correlate all the data simultaneously. Here, one question that comes in respect of the corporates: can I pay the director remuneration as a percentage of net profits? There is a circular issued in 1968 which says it can be paid in percentage of net profits. But then if you are following that particular thing, you got to take into consideration the TDS compliance under section 192B as applicable. At the same time, you got to ensure that you don't default on 222E deemed dividend provisions. And if that is the case, if the deemed dividend is attracted, then there is a separate disclosure requirement in respect to the corporates. But most important, if in case of the related party, there is an international transaction. Please note, even if the transaction is worth 1 rupee, still you got to file transfer pricing audit report. There is no exemption. For a domestic transfer pricing, there is a limit. For international transfer pricing, there is no limit. It is from rupee 1. And nowadays, government is examining the related party transactions very, very significantly using the risk management strategies, artificial intelligence, and they are concentrating on the information that you report under this particular clause vis-a-vis information that you report in AS15 industry of the corporates. And in case of the non-corporates, whatever information that you report under 48(2)(b, it is also cross-verified with the information reported in the individual ITRs of the respective persons, whether they are disclosing, whether they are discharging the tax liability as applicable or not. So please be very, very vigilant when you are doing the compilation and reporting of this information. And please take a certificate of the related party transactions for the record purpose. Mandatorily. Just don't take a certificate. Don't just go for a representation letter. Go for a certificate from the management. These are the related parties and this is what the thing is. Draft it very, very meticulously. And the definition of a related parties is defined under this section. I'm not touching upon. Coming to the cash payments exceeding 10,000 under 48(3). It is an incurrence of an expenditure in excess of rupees 10,000. Aggregate payment should exceed 10,000. And payment made otherwise than account pay or electronic payment options or a DD. That is, and this applies in a day. And it applies to raw material, trading goods, expenditure on salary also. And if you are paying such a cash for the acquisition of capital goods, please note under section 32, such asset is not eligible for the benefit of depreciation. Keep that in mind very, very clearly. But here one thing which comes to mind, if I have already disallowed under section 30-37, will I disallow again under section 48(3)? Answer is no. But if the payment has to be made to the transporter, then the limit of 10,000 has to be revised to 35,000 rupees. Take care of it. There are the exceptions provided under the rule 6DD. If this is the situation, then only this disallowance will not trigger under section 48(3). Other than that conditions, if you pay in cash, it will be disallowed. Now there is a recent notification which has been issued in case of the wages under the Minimum Wages Act. If any wages are paid more than 3K, they have to be paid through banking transaction only. It is the ancillary law which is applicable to a business enterprise. Many people will be paying the salaries in cash. So have we done the violation of that other law? Or will they verify vis-a-vis this by synchronizing the data? Data synchronization is very, very common. Every law is sharing the information with each other. Provision for gratuity. Yesterday, Chittade sir must have discussed the angle of provision for gratuity very substantially. Typically, any provisions that we make in the financial statements, they are disallowable. But if you are making the contributions to the approved gratuity fund, then they are allowable. Please note, provision and the contributions both are mutually exclusive. Both cannot be simultaneous. It has to be either provision. If it is a provision, it is to be disallowed under 40A7. And if it is a contribution, it is deductible. Please take that angle. Many people we have observed that contribution to approved gratuity fund is reported as a provision for gratuity. And then the notices come of the 143(1)A adjustments. Please take this angle very, very clear. And as a principal, when you are signing this particular audit reports, please examine this angle very, very closely. Many times we make the payment of gratuity contributions, but approval is pending. Will such contribution paid to the approved gratuity fund, will it be permitted? Especially most of the people may be paying to the LIC. If it is pending, still it is eligible for deduction, provided it is approved, but examine the relevant documentation and then write a suitable remark in the observation and remarks. You may quote this judgment of Chennai Tribunal. And benefits of such ratio may be applied to other kinds of similar funds too. Take care of that angle. Non-statutory funds, contribution by employers. Contribution to approved provident fund, superannuation fund, or an approved gratuity fund, if required by law, it is allowed. Means there is no dispute on this. But amount is not deductible if made as employer, but not applicable if made in any other capacity, or like setting up the trust, company, AOP, body of individual, society. And if it is not required by law. So this you got to examine very, very minutely. This is mark-to-mark losses. It's applicable to a very limited class of people, so we are not touching upon. 43B, it is clause 26. All kinds of taxes, duties, cess or fee, whatever name called under any law for the time being, if they remain unpaid before the time limit specified under section 139(1), it is to be disallowed. Similarly, ESIC, PF contributions or a superannuation fund, that way. Borrowings payable to the banking industry. It can be scheduled bank, leave salaries of employees, payable to the Indian Railways for the use of railway assets, or some payable as bonus or commission to employees. But if it's the same thing, such benefits are payable to the non-employees, then they will not be covered under 43B. Please take care of that angle. And it provides, if you are paid before the time limit specified under section 139, it will be this allowed. But if you pay beyond the time limits, then it is allowed in the next financial year, and you got to report suitably in the clause 26 of the tax audit report. But then if that is the case, and if you are disallowed in say 21-22 because of the deposit of such dues after the due date, if you are claiming, please verify vis-a-vis the previous tax audit report signed. If you have signed, there is no issue, but if the previous auditor has signed, please verify and then allow the deduction suitably. Another classic example, people borrow the money for paying the previous loan as well as the interest. If that is the case, then that would be disallowed under section 43B. Gujarat Supreme Court judgment. So that you got to correlate with the cash flow statements, auditors' reports, as well as the documentations and take a suitable call while disallowing under section 43B. Other disallowances. Capital expenditure we have seen, it is invariably any kind of capital expenditure will be disallowed if it is debited to the profit and loss account. If it is part of the fixed assets, you will be claiming the depreciation, there is no issue. Personal expenses, penalty, fine, violation. Not covered. If you are not following in that particular clause, then it is covered in the residuary clause. And if any expenditure that you incur, which is an offense, like it can be violation of a custom law, then also it can be here. It can be FDA, it can be FSSI, it can be shop and establishment, it can be any law for that matter. Any expenses incurred for entrance fees and the subscription to club, then that also is disallowed. Same way incurred for the availing the services at the club, that is also disallowed. If you spend any kind of an expenditure for publishing in the political party, then that is disallowed. Don't mix with the donation given to the political party, that is a separate deduction available. Contingent liability we have touched upon. Any kind of a direct taxes debited to the profit and loss account, that is expressly not to be claimed as deductible. Interest on monies borrowed for the payment of taxes, direct taxes, should not be considered as deductible. Interest payable to MSME vendors as per section 23 to be disallowed. But even if you are disallowing, you got to do the TDS compliances. And nowadays, they are mapping this information with MSME 1 that we file under the Companies Act. If you are following the mercantile system of accounting, then expenses of previous year paid in the current financial year for which you have not done the provision, that is to be separately reported in the tax audit report, clause 27B. That is, if you are following cash system of accounting, then there is no issue. And if it is a mercantile system of accounting, then also, if you have received the previous year income into current year's income, then that is to be reported separately. Coming to the TDS reporting part, clause 34. It covers both TDS as well as the TCS. All angle, PAN number, section, nature of payment. You got to report what is the total amount on which the TDS to be deducted or collected, total amount on which the TDS and TCS deducted or collected. And if there is a shortfall, that will also require. But here, most of the things which we have observed, many people have not even looked into the 206 AV compliance. And if because of that, if default has arisen, probably you got to correct it by asking client to deposit the TDS and take the remedial measures so that there is no disallowance under section 40, as well as under 43B, disallowance don't trigger if that provisions are made, and that is very important from the finalization of the balance sheet perspective. But there are some people who deduct the TDS when it is not applicable. Will it make any difference? And I think it doesn't make any difference. But here, what we got to look at, correct information is reported, and that is where our responsibility comes into the picture. And if the transactions which are supposed to be reported, which are not reported by the client in either of the TDS returns, then that will be required to be listed out. You got to quantify the interest payable. And you got to also quantify whether the client have paid the interest or not with the date of payment. But here the next question that comes, if there is a merger and acquisition, do I report the TDS transactions of the entity which got merged with me who has a different PAN number? The answer is yes. You can report that information. Under the income tax law, there is only one return. That previous company existence is no more as far as the legal status is concerned after the merger. So that information is required to be reported. Even though they have reported in their TAN number with the different filing details, you can report all such details together and report. And if you want to safeguard one more, you can put such a note in the observation and remarks also. But here one question that comes key: if a taxpayer is paying rent which is exceeding 2,40,000 rupees, he will deduct the TDS under section 194I. But he has drafted the license agreement in such a way where rent payable is less than 2,40,000, but he is paying maintenance charges to the society. And he is paying the property tax of the property directly. So in that case, if I take the combination of all three together, rent payable exceeds 2,40,000 rupees. So will I deduct the TDS on 2,40,000 or will I not deduct the TDS? The answer is TDS has to be deducted because you are paying on his behalf to the society, or you are paying property tax on his behalf to the government authorities. Second question that comes: several transactions are reported in GST returns by vendors, which are not recorded in the books of accounts. Such bills may be payable, may not be payable. Our client has not provided the bills to us. Do we check the TDS compliances if applicable? We got to check that angle. That reconciliation has to be in place. Whatever the data you are reporting under the ancillary laws applicable to a business enterprise has to be cross-related with every audit reports that you are signing under any law. And if there is a reconciliation, that should be kept on place. It is a sincere suggestion because after 3 or 4 years, when the mismatch notices come and we don't have a reconciliation in place, it creates lots of issues. Especially many people where the turnover is less than 2 crores who are not doing the GST compliances of filing GST R9. That issue invariably occurs. And even if like the bills are provided in the GST returns of GST R2A or 2A as the case may be, and if they are not recorded in the books of accounts, can we report profit reported by the enterprise or a surplus reported by the enterprise, whether it is true or correct? That is a food for thought. I come to my last slide. In this world, nothing can be said to be certain except death and taxes, which I started with, of Benjamin Franklin's statement. But let us be pound wise and even penny wise too. Because by not, if it is disallowable, and if we don't disallowable, we are taking the risk of 270A getting triggered, and which can be more damaging than anything else. Appreciated all of you. And I always say one should surround yourself with the people who talk about vision and ideas and not people. Thank you. With this, I hand over the charge to the organizers. Hello.
Yes, sir. Shall we take queries, if any?
Yes, hopefully they are easy.
Yes, sir. Sir, I'll just read it from the chat box first. And if any from the members, then we could take the same.
Sure.
The first one is that is obviously from my side itself. Now, can we claim for depreciation on computers at 45% since the highest rate applicable is 45% now in the block of assets?
45%, it is 40% only.
Yeah, the actual rate is 60%, but then it has been capped to the highest possible rate in the block that is being restricted to 40%. But now some assets have been made covered under 45%. So can we apply same to computers?
If it falls under that particular block of assets, and if it satisfies that particular conditions, you can. There is no bar.
Okay. Otherwise, not.
No.
Okay, sir.
Especially, like people, Apple phones and the notebooks, what they buy, they would like to capitalize as a computers. That should not be considered as a computers, but that should be considered as an equipment. One should claim the depreciation at a rate of 15%.
Okay, sir. So the next one in the chat box is whether the late fees paid for GST return, whether it will be treated as penalty or fine for the disallowance purpose.
Pardon, sir?
Late fees paid for GST return, whether will be treated as fine or penalty for disallowance purpose.
Sorry, I did not hear your question. Pardon me for that. Tell me.
Sir, we pay late fees now for the GST return. Under section 37,
Correct.
Could it be treated as fine or penalty and not allowed as deduction?
It to me is the late fees in violation, but it's not in the nature of a penalty, so it should be allowable as a deductible.
Okay, sir. Okay. The next one is, should interest on deposit be considered to determine tax audit applicability? I think that relates to turnover, I suppose.
Yeah, turnover if one is into that business of financing, then according to that, you got to define 44AB, no?
Right. So if the assessee is engaged in the business of earning interest, then it is included, otherwise not included.
Yes. See, one has to examine vis-a-vis the turnover, vis-a-vis the nature of business one carry out.
Right. So suppose the assessee is not in financing business, it is indirect income, then it should not be included.
It should be treated as other income, no, if that is the case.
Right.
And it will be subject to tax under the income from other sources.
Exactly. Right. Any other queries, please unmute yourself and you can ask the question, please. Yes, I think no queries.
I think I have confused enough everybody.
Ronak,
sir, can I ask? Sir, good evening.
Yeah.
Can you hear me, sir?
Yeah, Ronak?
Yeah, sir. So just wanted to check whether interest on TDS, is it allowable or not?
It is not allowable. It is not allowable.
Not allowable.
Yeah. I have already covered in my slide.
So, but just wanted to check any specific reason for that, because that TDS pertains to, it is not a personal income tax, right? This is your third party.
It is, see what happens ki, it is in the nature of a direct taxes.
Okay.
And interest, though it is compensatory, only in respect of the trade laws, it is permitted. Not for the TDS. There are direct judgments on this particular parts.
Okay, sir. Fine. And sir, what about education cess? Whatever we pay.
Yes, now it's disallowable, no, sir? There is a specific amendment in the Act of 21-22 itself.
Okay. So it is also disallowed.
It is categorized. Otherwise, there will be reopening of the assessments.
Okay. Thank you, sir.
Yes. Any other queries?
So sorry. Last question. So the clause 34 of TDS, right? So do we have to match that particular expenditure what we report in that clause with the P&L items?
Yes. Preferably you should. But what will happen? There are some expenditure which you must have debited the profit and loss account, which will
Exactly.
be subject to TDS.
Correct.
If we have reported that information in the TDS returns, then that will match. And if it doesn't get matched, that is also fine. But you need to keep the reconciliation in place.
Right.
What we prefer, we report such a transaction where TDS not applicable. But it is a choice how one wants to document it.
Okay. So the gist of that clause is not to reconcile with the PNL. It is just for our purpose. We keep the reconciliation.
They can always ask you to reconcile the information in the assessments. If you reconcile, if the data is matching, then probably they may not raise that question. Nowadays, in the assessment proceedings, if you report the salary of the employees where the TDS is not deducted as they are drawing less than 5 lakh rupees also, and if you file Form 24 with the suitable information, then they are not raising the queries. But if you report only on which the TDS is deducted, they're asking you to provide the bank summaries with the specific disclosure of the payments made to the employees.
Okay.
Just to ensure that no cash payouts made to the employees.
Okay. And so with respect to cash receipt, so as with respect to reporting, right, of this thing, SFT, correct? So the 2 lakh, which is the point number 13, if I'm not wrong, wherein they ask for the cash receipt about 2 lakh rupees. If yes, we have to report. So
that is, sir, that is not a part of today's this discussion. It's out of syllabus question.
Okay, fine, sir, fine. Sir, by watching you, sir, many questions arises because I have met you in one of the sessions, so I cannot control myself. No problem, sir. I can ask you offline. No problem.
Yeah.
Thank you, sir.
Thank you.
Sir, can I take one more question related to Form 26 QB TDS?
You can.
Sir, TDS on immovable property Form number 26 QB, we have to report it in clause 34, but it is PAN based. So does it get?
No.
So we have to report.
No, you don't have to report. That will not get. It is only PAN base.
So Form 26 QB related, we have to not report it into.
No.
Because
that will not get to.
Okay. And sometimes the deductee pays, the buyer pays TDS late because let us say he pays the entire TDS at the time of registering the document, but not at the time of paying installments earlier. So there is a interest default. What one can say? Do we need to report that in the interest column of TDS clause 34?
No, clause 34. See that property TDS. What you are going to pay, you are not going to claim that as your business expenditure.
So if I am a builder, then
builder you are not paying. It is the buyer who has to bear that interest. You don't have to bear that interest.
Yeah, I'm a buyer, so it's a stock in trade. That is, whatever purchase or land I'm purchasing, it becomes a purchases for me.
Okay.
So in that case, it becomes my expenditure.
Yes.
So where let us say there is a late payment of TDS because the entire TDS is deducted at the time of registering the document.
Correct.
And there might be a interest default because it was not paid at the time of installments.
Correct.
Do we need to report it?
You have to treat that as a late fees as well as the interest that you pay as disallowable, but that is not to be reported in clause 34.
Not to be reported in clause 34.
No.
Okay, sir. Yes. Any other queries? Okay, sir. I hope there are no queries. First of all, sincere apology. I cannot start my video due to some problem.
Okay.
I sincerely thank on behalf of Nasik branch for such a wonderful session and covering the topic so well in practical case studies format, where you discussed each point by way of case studies and putting all those important highlights and case laws. So on behalf of Nasik branch, I thank you for such wonderful session and enlightening us on this very, very important topic. Sir, we are eagerly awaiting for you physically in Nasik branch. So I hope we will see you soon in Nasik branch.
Sure.
Thank you once again for the session. I hope there are no queries. So I declare the session is over. Once again, thank you, sir.
Thank you.
Thank you.
Thank you, sir.
Thank you.